Hello, thank you very much for joining me. Today I just wanted to cover how much money do I need to buy something, right? We might have gotten pre-qualified. We're starting to get comfortable with the idea of purchasing something, but what are my out-of-pocket costs? What do I really need in the bank in order to purchase something? So for me, it's two things. It's going to be your down payment and it's going to be your closing costs. We'll start with the down payment. It's no longer standard to need 20% down. For a first-time home buyer, under a conventional conforming loan, 3% down. Even if you're not a first-time home buyer, 5%. There are also loan programs for 0% down. This is going to be a VA loan if you're active or retired military, USDA. They offer loans for rural areas. Um, but I should note on the USDA loans, there are geographical and income restrictions. So that is going to be a case by case thing. But just know that 20% is no longer what we need. And especially in Hawaii with a 650 median home price, let's say, that's $130,000. That's very difficult to save, um, especially with the expensive cost of living here. Um, so just be aware of that. 3% first time home buyer, 5% if you're not. And then, of course, anything on top of that only helps you borrow less and keep your monthly payment lower. The second part of your costs are going to be closing costs. Closing costs I like to break down into three pieces: title and escrow fees, kind of what I like to call hard costs, and then also prepaid items. Um, Title and escrow fees are what we're going to pay to the title and escrow company. Voila. And the escrow fee is going to just say, hey, we got to hire this escrow company. They're an unbiased third party who whose job is just to make sure that the transfer of funds is clean and fair and it's according to contract. And that's very important. Also, title, they're going to make sure that when the seller is selling you the property to the buyer, that the title of property is clear of any liens or any um, other positions that we're not aware of. That does come up, not often, but it does come up. So you're really paying these guys to say, hey, when I get title to this property, I want to make sure that it's mine, only mine, and nobody else has any kind of right to this property. And that's title's job. And that's what you're going to be paying for with title insurance, because when you do get title to the property, you are going to be ensured that this title that you're getting is as it is when you sign. So that's kind of nice. It's really nice, actually. Hard costs and closing costs are going to include things like your appraisal, your credit report. These are just things that we need to purchase or services that we need to buy in order to complete um, your loan application. Uh, and then lastly is going to be the prepaid items. Prepaid items are prepaid interest, your prepaid property tax, your homeowner's insurance. From the day that we close to the first day or the first mortgage payment that you make, we're going to collect prorated interest, property taxes, and homeowners insurance so that you're covered for this period, and then you can go ahead and make your first payment. And so we collect that up front at closing. And remember, all closing costs are due in full at the time of signing. Okay, so we collect that up front. We also have what we call an escrow account. Um, it's weird that it's named escrow, but it really doesn't have anything to do with the escrow company. An escrow account is a small account that we hold. Basically, the bank wants to be in charge of paying your um, property tax twice a year. They also want to be in charge of making sure that the home is adequately insured. So they want to be in charge of paying your annual insurance premium. Because of that, we collect a small part from your payment every month, and then we hold it in what we call an escrow account, impound account. And basically, every February and August, at least in Hawaii, when we pay property taxes, we're going to draw from this account and pay your February property tax. And when August comes around, we're going to draw from this account and pay your property tax. And in a year, when your hazard insurance is due, we draw from this account and we pay your hazard insurance. It's nice because you don't have to worry about those things. The bank pays it on your behalf. But just know that that is coming out of your monthly payment, and we hold it here. And then really I guess what I want to circle back to is that we do need to start off with some funds in this account at closing. So part of your closing costs will go into this escrow account. Um, and that's kind of more or less the prepaid items. Closing costs, you're going to want to budget about 2 to 4% of your sales price. And really, the difference between the 2 and the 4% is going to be how many points you want to pay. Points, again, are a percentage of your loan amount that you pay at closing in exchange for a lowered rate. But I hope that was helpful. Two pieces: down payment, closing costs. Um, and that's it. If you want to get a pre-qualification, they're free. From there, I'm really able to work backwards and say, hey, with this max loan amount and maybe a minimum 3% down payment, a little bit extra for closing, this is going to be your maximum sales price. And that's really how I like to use your liquid cash that at pre-qualifying upfront to work backwards and say, hey, this is what we can do for you to get you out there shopping. Thank you very much for your time. I hope that was helpful, and have a great day. Thank you.